Imagine getting paid every 3 months just for owning a piece of a company.
We're talking about dividend investing, one of the most popular ways to earn passive income from the stock market.
Today, we'll break down what dividends are, how dividend stocks and ETFs work, how much you'd really need to invest to make $100 a month, and the traps to avoid.
By the end, you'll know exactly how to decide if dividend investing is right for you.
First, what is a dividend?
A dividend is a payment a company makes to its shareholders, usually from its profits. Think of it as your share of the company's earnings.
Not every company pays dividends. Growth companies often reinvest profits to expand. But many stable, mature companies like Coca-Cola or Johnson & Johnson choose to reward shareholders with regular cash payments.
These payments are usually made quarterly, though some companies pay monthly or annually.
You don't need to own hundreds of shares to get started. Even if you own a single share, you'll get the dividend amount for that share.
You can earn dividends in two main ways: by owning individual dividend-paying stocks or by investing in dividend-focused ETFs.
Dividend stocks are straightforward. You buy shares in a company that pays dividends, and you receive those payments directly.
Dividend ETFs are collections of many dividend-paying companies bundled into one investment. They spread your risk. If one company cuts its dividend, others in the ETF might still pay.
For beginners, dividend ETFs can be less stressful since you don't have to research and track dozens of companies yourself.
But remember, whether it's stocks or ETFs, the amount you earn depends on the dividend yield, which is the annual dividend payment divided by the stock price.
Here's the question everyone asks. How much would you need invested to make $100 a month in dividends?
That's $1,200 per year. If your average dividend yield is 3%, you'd need about $40,000 invested.
At 4% yield, you'd need about $30,000. At 5% yield, it's around $24,000.
And remember, higher yields aren't always better. Sometimes a very high yield is a red flag that the dividend might not be sustainable.
So while $100 a month is absolutely possible, it usually takes years of steady investing and reinvesting your dividends to reach that point.
Let's take a realistic example for a beginner investor. You start with $250 a month into dividend-paying stocks or ETFs. And here's the key. You reinvest every dividend you get, every single quarter.
We'll use a 4% dividend yield and a 5% annual growth rate. Now let's see how it actually plays out year by year. After year one, you've put in $3,000. With growth and reinvestment, you'd have about $3,159, and your dividends going into year two would be around $126 a year.
By year three, you've invested $9,000 total. Your account is worth just over $10,380, and your annual dividends have grown to $415.
At year five, you've invested $15,000. Your account is about $19,000, and you're getting over $760 a year in dividends. That's more than triple what you started with just 4 years ago.
Year eight, you've invested $24,000, but your account is now around $34,000, and your dividends are over $1,350 a year.
At the 10-year mark, you've invested $30,000, but you're sitting on about $48,600, and your annual dividends are almost $1,944. That's over $160 a month.
And remember, every single quarter along the way, those dividend payments bought you more shares, and those new shares started paying dividends too.
That's the snowball effect in action. At first, it feels slow, but as the years go by, the compounding gets faster and more powerful.
Now let's talk about dividend traps, the mistakes that can cost beginners a lot.
First, chasing high yields without understanding why they're high. A company paying 12% might be in trouble, and that dividend could be cut at any time.
Second, ignoring the total return. Dividends are great, but if your stock's price is dropping faster than the dividends you're collecting, you could lose money overall.
Third, not diversifying. Putting all your dividend money into one or two companies is risky. If they cut their payouts, your income could vanish overnight.
And finally, forgetting taxes. Depending on your country and the type of account you'll use to purchase these shares, dividends might be taxed differently than capital gains, so plan accordingly.
Dividend investing can be a fantastic way to build passive income, but it's not instant and it's not magic.
The real power comes from patience, consistency, and reinvesting your dividends over time. If you start small and stay consistent, you could one day live off your dividend income, or at least have it cover some of your bills.
And if you found this helpful, hit that like button so more people can learn about building wealth through investing, and subscribe to join us as we help you take control of your money and your future.